It's our quarterly check-in on the TA report. You know, it's your boy Bags with JFDI, Nick, and GP. But we always love to check in quarterly. Hell, we'd love to do it more often with our guy, the Pivotologist on Twitter. But you may know him and love him. Hell, you may hate him for his trolling antics on Stock Twits as Cookie. Hey, Cookie, it's great to be back with you again. It seems like every time we do one of these, the market is struggling, but I can't really say on June 19th, 2022, that the market's exactly struggling here.
I think hey, first of all, it's great to be back with you. And just to what you said, I think it's probably the first time in 9 months that I've been on this call with you, and the market hasn't been fighting for support. So hope I don't jinx it.
Well, if we do, we know where to place the blame. But besides that, I know Nick and GP are always excited to hear you, and we're always interested in your take on the market. Is there anything that you want to just look at right off the rip, and I can let you share your screen, or we can just go into what we think things look like on the broader market to start things off?
I think we just start with the broader market, if you're okay with that.
Perfect. Yeah.
Yeah.
The Qs obviously ripping since the October lows, and we had our podcast last night. Obviously, GP is a very randy bull over here, and he doesn't think that anyone knows what's coming for them. And Nick and I are like, can we just get some pause, please? Which camp are you in?
I mean, we've been preparing for a pause since the end of May, right? So we've been thinking, oh, the market is going to consolidate now. It's going to consolidate now. If it loses this level, then we probably go sideways for a couple of weeks, and it just keeps going higher and holding support. So as far as where we closed on Friday, again, you know, I think I mentioned 371 on QQQ a couple of weeks ago, and we got to that level last week. So it's another area of interest that could mark the beginning of a consolidation, but not necessarily so. So, you know, I would say we're open to consolidations at this level in the market, but we're not going to assume that, and certainly not take short positions because we think prices at resistance in an uptrend. But I think it's just opportunities to how deep we can get any consolidations. I think Nick was saying just a couple of minutes before we started the call, it would be nice to get consolidations and pullbacks. I think everybody would love that, but the market's going to do what it's going to do, right?
Yeah, and it's interesting when you look at the macro, right? Like things have in the US and across the world have gotten incrementally better as far as inflation goes. And I know you're not a big macro guy, you're straight into the charts, but you have what they're calling a hawkish pause by the Fed. Like it seems like the news machine is still trying to put out there the hesitation, the wait, and it leads into what I call all the time is miserable bear theory, right? Like I'm not going to buy in, I'm just going to wait. I'm going to wait for it to get lower. I'm going to wait for it to get lower. And if you've waited for it to get lower since March, you're still waiting, basically.
Yeah. I think the starting point is mistaken for too many people here. I mean, I would even go so far as saying that I don't think rates and inflation is the story anymore. No. And I think, you know, if we go back a couple of months, I remember thinking, if we start seeing company earnings coming in line and slightly better, we see inflation is being flat, then we just got to move on, and it's going to be something else that moves the market, because I think that's all news now. Even and this is, I think, one of the mistakes that many people are making is that they're still stuck in 2022 narratives, whereas there's this humongous narrative that's taking hold, which is innovation and technology again. And many people are either writing it off as a fad, but I think it's probably the most important thing, even probably more important now than what the Fed does. And if you look back over the last couple of cycles, like Fed meetings and inflation reports, you could argue there were reasons why the market could have sold off at each of those occasions, but it never did. And so what that does is it confirms or validates in my mind that that's not the burning issue anymore. And I think while people are still stuck in 2022 narratives, they're struggling to get on board. So it's not about price levels anymore. It's not about price levels. It's not about inflation. It's not about what the Fed does. It's a bull market driven by certain macro innovation trends and things, which is what happens in bull markets. And I think, I could repeat half of the 1,000 posts on StockTwist, but unless people let go of the baggage that's held them back for a year. Hold on, what the post I'm trying to remember is this one. The difference between COVID and what we have now is COVID was very quick. It came and it lasted 2 months as far as the market cycle was. We dipped, we crashed, then we recovered in 2 months. So there was no entrenched bearishness. You could argue that stimulus was too much and we shouldn't have happened and all the rest of it, but people didn't get time to become entrenched in those bearish views. But if you look at what happened over the last year and the discussion that we've had on the podcast over the last year, and I remember GP saying the market's just gone sideways. It's just gone sideways, and he'd be saying it a bunch of times, and he was right. And during that period, that bearishness was just getting more and more entrenched, right? And so now what we have is the market breaks out of a 9-month range or a year-long range, and that year has basically just swamped everybody's minds. They've all gone, they're all like, recency bias, if you want to call it, right? So everybody's just stuck in narratives which I think are no longer relevant. Well, that's my quick take anyway. I mean, I could be wrong, but certainly the market seems to be playing out in that vein.
Well, you reminded me it was 2023. I obviously forgot because I titled this episode June 19th, 2022. So thanks for correcting me on that.
There you go.
Not that I was expecting price action to be that. I've been saying that it's quite a bit different, but I can remember back in I want to say 2 or 3 quarters ago, and even before that, you were saying the innovation is what's going to really lift the market higher ultimately. And then we get all this movement in the AI stocks, the NVDAs, the Microsofts, et cetera, of the world. Are we in just the tip of the iceberg of this bull market? Or this was a question I asked the guys yesterday, or did we just end the bear market? We're not in a full bull cycle yet.
Okay, you ready for this? I think we could have 10 years.
Yeah.
I think it could go on for a decade. And that doesn't mean we'll go straight up for 10 years, but I think we could see 18 months, 2 years, 2.5 years of just rampant Randy bull action, as GP would call it. The pretty decent corrections, which we will undoubtedly get, and then it will just continue to chug on. And again,
are you thinking that because of as AI and how that's going to just impact us on a massive level?
Yes.
Yeah. Okay.
Yeah. I mean, I think the only way that we'll get those multiples to expand in a way that makes sense to people is if innovation drives that.
Right.
So if we want to see tech companies like Facebook and Apple and Google grow into those multiples again, then it's got to be driven by something that affects their top line, right? So and the only way you can do that in a market that's saturated with existing technology is new technology. So that's the only way you're going to drive that. So new technology will create efficiencies, replacement, automation, all that stuff. That sounds cliche, but it's actually true. And
Cookie, just a quick question, right? So NVIDIA was obviously the big winner in this mini cycle here. They came out and guided some ridiculous number that no one ever thought was going to happen, and which is why the move happened. But the question I have is, what if it's not just NVIDIA? What if a lot of these stocks come out and saying, hey, we issued guidance for, let's say, 3 billion, but it's actually going to come in around probably closer to 5 or 6. And so what if the NVIDIA guidance is just the start of the conversation of how this AI spend or innovation spend, whatever you want to call it. I don't want to call it AI because that's the buzzword, but it's basically technology, right? And if this technology spend is just the start of that conversation, not the end of that conversation.
Yeah, that makes sense. Absolutely, it does. I think we've got to draw parallels with similar innovations like the internet, which weren't just limited to one sector or one field or one type of business, but it affected all of business and commerce. And so when you think about AI, it's not just about making chips, and it's not just about ChatGPT. It's not just about Midjourney and paintings and or images, but it's how it's going to affect, for example, research into drug development, how it's going to affect autonomy and self-driving, and even quantum computing, and even blockchain. I mean, I think it's going to be the glue that's going to bring together a dozen different innovations over the next 3 or 4 or 5 years. And if we were to draw parallels to the internet, I think it's an order of magnitude bigger than the internet is going to be, which is saying something, because the internet is not exactly a small innovation, right? So, and I think that's one of the reasons why I think either you buy into that or you don't. And for those who don't buy into that, then the only thing I would say is, which is what I've been saying for a couple of weeks or months now to the guys that I trade with, is spend an hour every weekend just to immerse yourself in whether it's YouTube videos or reading articles or anything to do with AI, because then at least you can say that I've done my research and it's bullshit. Or hopefully, which is what I'm expecting, is you'll realize it's a lot bigger than many people think. And then that then starts changing how you address the market. And so going all the way full circle and to how high this market could go and consolidations and stuff. The way that we're looking at consolidations in the market is as an opportunity. So all consolidations, all pullbacks will be opportunities in a bull market. So it's either a small opportunity to get in or a bigger opportunity if we get decent pullbacks, but they're all going to be opportunities until and unless the driving force, which is AI and innovation, is taken off the table. So the only way this can be stopped is if that innovation stops. So then you start saying, well, how likely is that? And I said, that's
hasn't happened since the beginning of man.
Exactly. It's very unlikely. So you can say, well,
regulation, right? That's the only thing that comes in and says, hey, you're not allowed to do this. And that would put a halt.
But even, right.
It happened to like XBI, right? Back in 2015 when the presidential candidates went hard after pricing. Right. There's ways to do it, but it's still early in that cycle, I guess is the point as well.
But I think regulation is part of the cycle. It won't stall the cycle. It's part of the cycle, right? So I think
pace it.
Yeah, absolutely. So I think it will give safeguards, safe rails, or whatever you want to call it. Well, the terminology is to grow it in a way that's safe and responsible and doesn't wipe out mankind, which everybody's crying about. But even with those safeguards, the opportunity, I think, is tremendous. Right. So I don't think it's going to. No, it might, because it's going so quickly. What would an extra 1 or 2 weeks or months or 6 months make? It makes zero difference. It's going incredibly quickly. And that's the, I think that many people are just not seeing. They're just seeing ChatGPT and thinking that's it.
So Cookie, we know from your posts and you talking with us, some of the innovation names that you like, obviously, are the Teslas and NVIDIAs of the world. What other companies, this is not, investment advice on saying to buy, but what other companies do you think could be these emerging plays that fit alongside the Teslas and NVIDIAs?
Okay, so I'm very pragmatic when it comes to stock picking, which is I don't pick stocks, right? And let me explain that. There's going to be a first wave, which we're seeing, which are the chips, right? So the semiconductors went wild for from the beginning of the year, and then you're seeing. So basically, there's the manufacturers of the technology itself, which are the chip makers. There's the enablers of AI, which are companies like Tesla, Google, Microsoft, Apple. And then there's going to be everybody else, right? So whether you're a digital education provider, or whether you're doing healthcare, or whether you're doing something else, if you're in the S&P 500, then chances are you're going to have you will be a company that's going to be massively impacted by AI to a certain level. So
it literally is. It literally is the internet 2.0. It's like if you didn't get on board and embrace the internet, you got just left behind. Essentially,
right.
And,
so just buy the S&P and the QQQ.
Yeah,
seriously. Just do that. If you want to make money and you don't want to get it wrong, right? By picking something that might be 6 months to, it might have a longer runway to like grow in, then honestly, just be pragmatic. There's no better ETF than QQQ and the S&P. There really isn't, right? And we can talk about robotics, AI, robotics ETFs and AI ETFs and ARK and all that sort of stuff, right? And you could have exposure to those things, but going down a level from those smaller ETFs to picking individual stocks, whilst it's fun, and you might get outsized returns, but you're also picking up more risk as well, because there's a lot more volatile. You take a look at individual names like AI, whatever it's called, AI.C3 or something. I can't remember the name.
Yeah, C3 AI.
It's incredibly volatile. So whilst it might triple in value, you'll be taking 40% haircuts every 2 months. So, I mean, do you want that? I mean, some people might. We can talk about that later in the call, about knowing yourself and knowing the market are key to making money. It's not just about picking the right thing, but it's knowing how you would react to a 30% drawdown in something that might still go 10x. Mm-hmm. It's not everybody's ready for that. So
not everyone has the stomach for that.
I don't personally. I don't. I hate that sort of stuff, right? So I'll day trade stuff like that, but I won't swing stuff like that. And so I think don't. And again, I'm not giving advice and stuff, but don't get hung up on trying to pick individual names, if by doing so you miss an opportunity, which is the market.
There are exceptions, Cookie, because Tesla falls into that crowd.
No, sure. And actually, I grouped it separately, right?
Yeah.
Said I'd put that in the second bucket. I'd put the mega cap tech in a separate bucket on their own. And then I put the indices after that.
Yeah, and Tesla was not a mega cap until a couple of years ago, right? It was a company that wasn't sure that was gonna, and it's even as a mega cap, it's having these wild 70-80% drawdowns. I think it's bananas, but it's hard to hold it, right? Unless you're a long-term shareholder and you can see the vision. It's similar, like AI3 or whatever the stock symbol AI has some of the same similarities in terms of volatility as Tesla, but how do you decide? I guess the question is, how do you decipher between AI and Tesla?
Yeah, well, mega cap, and I think reputation, track record, having got products out, leadership. There's a bunch of names, a bunch of reasons, I guess. But I mean, this might be a good segue into what Bags you mentioned at the beginning of the call. If you want to talk about how to manage a portfolio, or we can come back to it later on in the call if you want to. But
I have one other thing while we're talking about innovation, and the space that we're leaving out is crypto, right? Blockchain technology and cryptocurrencies were often seen as hugely innovative, and they're not participating price action wise as much as we see all these other contributors to the broader market, especially the mega cap. So just real quick, what are your thoughts on Bitcoin, Ethereum, and crypto as a whole, the ecosystem of crypto as a whole right now, Cookie?
Okay, so there's a lot of moving forces there, and I think a lot of it I'll start off with talking about timing. And I think Bitcoin and Ethereum and all those shitcoins had their AI moment 3 years ago, 2017, 2008, hold on, 6 years ago. It seems like a lot longer ago, right? So they had that moment 4 or 5 years ago when they came to, like, everybody started talking about blockchain and Bitcoin and all that sort of stuff, right? As far as the addressable market with crypto is concerned, it dwarfs in comparison to what AI could deliver. So even though all of these technologies will be developed along the way and they're being done in parallel, the reach of blockchain wasn't going to match AI if AI delivered. So I think what you're seeing now is, I mean, don't forget, Ethereum was $5 in 2017. It's still $1,800 today, right? So they've had enormous runs. They've had massive runs. But what we're seeing now is the technology is maturing a bit. We're seeing a bunch of cowboys and idiots in the space, which are getting wiped out one by one as the years and months go by. And eventually we'll be left with the technology and the innovation which will survive, and how that forms a part of an umbrella of 5, 6, 10 different innovations over the next 5 or 10 years. Now, I don't think I never expected blockchain to be as big as, let's say, AI might become. So my expectations were always quite reasonable from that point of view. How that impacts price action and stuff is slightly different. But just to end this point, I think we will, blockchain is still going to be necessary. Right? We're going to need blockchain. We're going to need ledger technology. We're going to need that as part of Web3, and we're going to need that part of a bunch of other different technologies and platforms in the coming years. What companies and projects will form part of that is yet to be decided. I mean, clearly, we've got Bitcoin is likely to survive and continue. Ethereum is likely to do the same as it's a leader in the space. As for all the other shitcoins that are behind it, I have no idea. And how they will come out of the other side of regulation is yet to be seen. I don't think the space will die. I don't think regulation will kill crypto. I think it will enable it. But you will find that the stronger projects today, which are cash rich, which have got a bit of money, which already managed to raise billions of dollars or hundreds of millions of dollars when they were able to, will be the ones who can afford to continue and develop the technologies, even though they might be named in the suits. Like, for example, Matic, even Solana will probably survive, and some of the others, XRP will as well. And they will trundle on. And once they get regulated and they get all their paperwork in order, and they end up being, my guess is they will end up on regulated exchanges like the New York Stock Exchange and the NASDAQ. And so what you'll end up what I think will end up happening, this is just my guess, no idea, is all those shit exchanges will disappear, or they'll get dwarfed, or they'll lose a ton of business. So what you'll end up seeing is regulated coins on regulated US and international platforms. And that'll be the future. So you see tokenized securities, tokenized coins, tokenized everything, and it'll be on the NASDAQ. And so you'll see Apple tokenized, you'll see Tesla tokenized, and it'll all be on the blockchain and ledger and all that sort of stuff. And as well as, or together with, I should say, the Matics, the Links, the Ethereums, and all the others, they'll be on the same platforms as Tesla will be. I don't know if that's what you're expecting to hear.
No. I mean, I think that's
the only way it's going to happen. That's the only way the regulators will allow these projects to survive. And the projects will need to raise capital and need to raise money. And they're not decentralized. Most of them aren't decentralized. So there are teams and there are developers working on this stuff, right? And they need to get paid. So in order to raise capital, which is not a bad thing, they'll get regulated, they'll end up on exchanges, they'll raise their capital, they'll do, dilute their shares, all that sort of stuff that everybody else does. But just in the name of blockchain. I mean, why should they be any different to anybody else? If you think about it, why should they be any different? So that's my guess as to what might happen with the crypto space in the next 2 or 3 years. It'll continue. You'll still see leaders. You'll still see a lot of success in that space, but it's just going to look a lot different, I think, to how it looks today.
So if I were to give you $1,000 and say, I want you to put this in Bitcoin, Ethereum, Tesla, or NVDA, what are you doing with that $1,000?
Oh, that's difficult. I think, well, the ones that you just named, there's nothing wrong with any of those projects that you just named, though, right?
For sure.
And I think they're all decent, respectable projects. But how I would decide to allocate would take into account the trends that each of them are in, which is what I always do, right? So I'll look for those which are strong, which have strong trends. I'll look for those which are coming to the ends of consolidations to try and jump on a newly emerging trend, whether it happens to be Bitcoin or whether it happens to be Tesla. I don't give a shit.
Yeah.
I just want to make money.
But the reality is you put $1,000 in Tesla right now.
Yeah, right. Yeah, exactly.
Of the four, I mean, I think that's definitely the best trend currently, right?
Right, but because it's the best trade, not because it's the best technology, right? So that's the point.
Correct.
Right.
It has the most potential at the point, right?
Right. But then you say, well, I want to take my foot off the pedal with regards to Ethereum and Bitcoin, because coming out of corrections, well, maybe they'll do well in the next 3, 4, 5 months. We could talk about how their charts look a bit shit, but as I said, I don't think they're going to die, but I want to put nothing there, let's say.
Yeah. So one thing that we wanted to get into was managing a position, specifically trading around a position. And I think this segues into that nicely, right? So I hear a lot of traders or a lot of folks out there on Stock Twits or Twitter, wherever, it's all or nothing, right? You're buying all in and you're holding forever, or you're selling it all, And in reality, that's not necessarily the most profitable or the smartest way to manage positions. And just for me, like I leg in lower, right? I keep buying as it goes lower. And as it starts going higher and I reach my price targets, I start selling some of that off. I don't feel like I need to manage all that together, right? I'm taking profits as it goes higher. And this is for any of the three of you. How specifically do you guys manage your positions and trade around positions that you either A, want to maintain, or B, want to accumulate more in over time, but don't want always to have the highest cost basis?
I'll go last.
Generally speaking, if I'm in a if the it's all based on the trade plan. So like if I'm looking to get into like a more expensive name and I'm looking to trend trade it, I'm generally going to be setting my initial my risk based on the weekly ATR, whether it's 1 or 2x. So I'm going to end up taking a portion of my position off at 2x ATR if it starts to work in my favor. At that point, it puts me in a risk-free trade, and I'll just set a trailing stop under whether it's the 20-day or 50-day. If it's a shorter term trade, like my favorite patterns to trade are A, B, C, D legs. So like if I'm buying like a B point breakout, I'm going to be taking a lot, like, let's just say 70% of the position off when that D point gets reached. And then the same way, if I'm going to let that other 30% run as just like a runner position, I'm probably going to be pretty lax with my trail stop. I'm not the greatest at like really building into, I'm not as good at building into positions. It's definitely something I'm working on, but it's taking time.
For me, it really depends on the stock, I would say, on what I want to do, right? So let's take Tesla as one of the greatest examples, is like when it gets to a point where it's a no-brainer in my eyes, right? Based on what I know and believe, it's okay, how much do I want to allocate? I want to allocate another 10%, 20% of the portfolio, because I think this is unbelievable opportunity. I don't want to throw the 20, let's say 10% at it at the whole time. So I'm like, okay, this is the level that I thought it was going to hold. I'm going to start there. And then there'll be levels underneath in 10%, 15% price drops from that level where I will add in batches. And it's usually about 3 to 4 batches that I will continue to add on. And then I will wait and see the scenario kind of play out. So for Tesla, I started adding around 198. I think I bought like a few shares, and then I had a lot bigger positions as it scales down, right, to add in more. And I stopped around, I think 116 was the last buy for me. And yeah, it went to 101, and everyone's like, yeah, see, it was a bad buy. And then a couple weeks later, it was back to like 215. So I think it's scaling into positions. I think a lot of people don't know how much they want to invest when they first start investing into a stock. They're just looking for gains. So having tranches and thought out process on how much you want to put in. Like, let's say I want to put in 10 grand into Tesla, and it was at $100, $200 a share. You can get up to 50 shares. So how do you want that to play out? Do you want to buy all 50 at 198 and be miserable for however long it takes to get back to 198? Or do you want to buy in small lots? So there's
two things on that, GP. One, you just threw out 10 and 20% holding. I know you didn't just make up those numbers. Those are numbers that you've either used or focus on when initiating or legging into positions. Like, what is the largest position size that you want to hold on in your portfolio? Is it 20%?
I'm more concentrated investor versus the diversified to me, my thought process has always been, so you have to figure out who you are, right? First, I think that's a really important part of investing. So I'm under the fundamental view that being concentrated in stuff that you've done your due diligence on, and it could fail at any point in time. I'm not saying that. It's a better bet, right? So the example that I give quite often is when Tesla in 2019 came back to retest the 180 level, which has been sideways for 5 or 6 years. I had a decision to make. Do I want to sell my Apple to allocate more Tesla? And that's exactly what I did, because I thought it was a generational opportunity to buy back where I bought 5 years ago. So I'm a concentrated investor. I don't have 30, 40, 50 positions because I'm active, right? So if something doesn't work out, then we've talked about this on other podcasts. It's like, in this day and age of buy click in seconds, nanoseconds, there's no reason to be shy about getting in and out, right? So I like staying concentrated because that generates some of the biggest wealth, in my opinion. Some of the biggest wealth creators on this planet are the ones who have believed in themselves, right? Look, Bezos, Elon, all these guys are concentrated in one position. They're not diversified. They diversify through their company, but ultimately, if their company goes bankrupt, they're done, right? They don't have much money left. So I've always had that viewpoint, and that's kind of how I do it. So my concentrations are usually higher than others. Like in 2019, I think at some point, Tesla was like 60% of my portfolio. And then I trimmed on the way up because I thought it was a great opportunity. And the stop loss at that point wasn't heavy, right? It was at like 176, all the pre-splits. So I was like, I can lose a few bucks here, or I can see monster gains, right? So that was the thought process. And then I started trimming as I get to the 50% mark, the 100% mark. So I'm not at that 60% concentration, and stop loss isn't that big at that point. The risk reward was monster, in my opinion. They were doing over $25 billion in revenue at the time, and they were valued at, I think, 29 billion, right? And they were growing monster, and they were executing and all that stuff. So that's the way I thought about it there. Every position's a little different. I can't apply one methodology to just one stock or one viewpoint, you know what I mean?
But to be in a 60% weight of your portfolio, like, you are pretty damn all in on this stock at that point, right? Like, you are very confident that this is the right thing to do. You're not just throwing 60% weightings around like that was Tesla.
Yeah, but back then Tesla was on the verge of bankruptcy, right? Like, this guy was literally posting April Fool's jokes on bankruptcy, right, and going to jail. Like, people forget how miserable it was to own Tesla from 2014 to 2019 until the big breakout. It was a miserable hold because a lot of times you gave back 50 to 100% moves, right? If you were a long-term investor. And so my thought process was just exactly that. I was like, I'm at the point where I bought, it's a horizontal support of the last 5 or 6 years. If it breaks here, I'm going to lose maybe 5%, right? And then I can get out and then I can reassess. Or if it doesn't break and it holds, it's going to have a monster run, because this is a full retest on a technical basis of a 6-year base and the bottom of the base, right? So that's the way I looked at it, and it worked out. Doesn't always.
Cookie, the floor is yours, sir.
Okay, well, I mean, just to say from the outset, I think what I can share is not really very different to what GP and Nick have said. The only thing I would add, at least as an introduction, is I think why should we swing? Why should we scale in, scale out? Why should we hold positions? Because I think if you think about the mentality in the market right now, where there's that huge wall of worry, despite the fact that the market's going higher, the first question to answer is why should we swing in the first place? Because there's so many people who just don't want to do that, right? And so I think the starting point is, well, if the market is bullish, which it is, then to make consistent gains, you got to swing positions. Now, that doesn't mean you can't make money by day trading. And I think, as always, it will come down to a combination of the two. But while we're in a bull market, however long that lasts, I mean, I mentioned 10 years, but let's say, it lasts just 6 months or a year. But for the amount of time that we're in a bull market, it makes sense to hold positions as opposed to opening and closing positions every day. So with that as a starting point, how can I help structure a framework to make it easier for people to do that? And I think, there's so many stories, and, everyone say, oh, I held AMD at $3 back in the day, or I held Tesla at $15 or Ethereum at $5. Oh, I knew I should have held it, right? And everybody says that. Everybody has stories like that. And the reason why they keep saying those things over and over again is because they were never able to come up with a framework to help them do that the next time that situation came up. So if you want, I can just share with you just a couple of ideas to how people might want to structure how to do it.
Sure.
Because as I said, I think Nick mentioned it as well. It's about having a plan. You're not going to swing because you decide one day you wake up and you're going to swing and hold positions, but you need to have, I think you need to have a plan. And even with GP saying 60%, he's thought through that and he's got a plan behind that. It's not just, I want to hold 60% or 50 or whatever the number happens to be in Tesla. So you've got to be mentally prepared to swing positions. It's not going to happen overnight. And I think many people will struggle to swing positions because they've been so used to the market going sideways for a year, going back to the point we made at the beginning of the call, that it's going to take a lot of work to get people in that place mentally to be able to hold positions which might go red on certain days, right? And not feel compelled to sell them and close them out. And that's why we come in, that's why then we start talking about scaling in and scaling out. How can we hold positions responsibly and manage risk despite the volatility we're going to see along the way? And so if you want, if you let me share my screen.
Sure, absolutely.
Let me see what we've got. Hold on. Let me go to share screen, see what we're going first. Yeah. It's probably not the right page, but let me just go here first, go here, right? Okay. So this is going to come across a little bit like an MBA class, right? But if you've got 5 minutes to discuss it, I'm more than happy to share through just the very basic parameters to how you might set up a plan and then how we can scale in and scale out, right? And it's going to touch upon, and it's going to touch upon some of the points that GP mentioned anyway. So I think that'll be good. So, as GP mentioned, there's two dimensions here. It's knowing the stock you're holding and it's knowing who you are as a person, right? So both things need to come together for you to be able to swing successfully. So the things that I take into account are things like how volatile is the stock that I want to swing. Right, so let me give you an example, right? So I'm going to put SPY over here, QQQ here on the left. So for me, these two, the indices, are the least volatile names that I can think of in uptrends that I'd be comfortable to swing. Right, so I'm going to put these on the left-hand side. And then all the way to the right, I'm going to put AI, C3, or whatever that name was, right? I'm going to put that there. I'm going to even put natural gas there, but just to illustrate the point. I mean, this is a shithole of a thing to hold, right? I mean, it's been extremely volatile, right? But I'm just going to put it there just to show you the extremes, right? And then in between that, you could have things like Apple, right? And then you could have, I don't know, Microsoft, which hasn't been that volatile. You could have Google there, right? You could have Tesla, which is more volatile. And then you could have others along the way, like NVDA, right? And even AMD, for example. So basically, all I've tried to do here is from left to right, least volatile to effing volatile, think of a better word, right? Really volatile. So when I'm thinking about swinging or positioning, what I'll do is I'll say, right, on the left-hand side here, I'm going to swing only, right? I'm only going to swing those. I'm not going to day trade those because the volatility isn't there, right? So I'm not going to day trade and SPY. And I'm only talking about commons. I'm not talking about options trading or leverage with margin and all that sort of stuff. I'm just talking about buying and holding and simple swing portfolios here, right? So I'm gonna swing that only. I'm gonna swing this only, I'm only going to swing Apple because it's not volatile enough. But then you start coming down, you go down the line and you start saying, okay, now these are slightly more volatile. So here I'm going to swing and I'm going to scalp. Right. So, and you can say, well, okay, the same here. I'm going to swing and I'm going to scalp. Here I'm going to swing and I'm going to scalp. Right. So there's a bunch of these which are sort of in the middle of comfortableness or comfort as far as swinging is concerned, but I know they're quite volatile. NVIDIA, I'm going to say swing scalp also, right? Because it's quite volatile, right? It can be. AMD is the same. And then you get to the right, hold on, swing, this way. I could have just copy pasted, this would have been easier, right? Swing scalp. And then on the right, you've got these, which are insanely hard to swing. So I'm going to say, or let me just say from the outset, the starting point is all of them are in uptrends. Right, so for the sake of the discussion, natural gas is in an uptrend, which it might not be, right? But anyway, natural gas is in an uptrend and AI is in an uptrend. So here, even though they're in an uptrend, I'm going to scalp mainly, and I might swing some. Right, and the same here, scalp. So the focus of my position is slightly different as I go along the volatility spectrum. That make sense?
Yep.
Yeah.
Right. So then what I'm doing is, so given that I'm going to swing. So I will never take, well, hold on. There's a few different variables here. So let me put in one more here. Right? So what would be my ideal swing? What would be my ideal position here? Let's say, because these are they have the least volatility, they'll have the greater size to begin with. And again, this might be a little bit different to what GP had with regards to, having 50% in Tesla. But here, so for example, I'll say from a scale of 1 to 10, this could be an A in terms of size. This could be an A in terms of size. This could be an A in terms of size, right? And then as we go across, as they become more and more volatile in nature, then I want to swing and scalp smaller, well, certainly swing smaller positions, 5, 5, 4, 3, 3, well, hold on, 2, and 1.
Wouldn't you increase your size on, like, I feel like it would almost have the largest position size in your swings kind of drop down into your scalp, and then on your swings, and then those more volatile, if you're just scalping, you wouldn't take bigger.
So what I will do, it's a good point. So these are just swing sizes, right? And then I'll say scalp size.
Oh, sure. Okay.
So then what I'll do is, so here there's 0, because I'm not going to scalp these. There's just no volatility there. But then as I go along this side, then I say, well, here, I'm going to put like 100 here, for example, right? To your point.
Oh, sure.
Or here,
okay.
This could be 100 there. So remember, when it comes to scalping, I'm focusing on opening and closing the trade every day. So I'm not sleeping with that position. So I'm okay with having larger size, but I know I'm going to close that trade down. But because they're so incredibly volatile, I don't want to swing them overnight, because I might wake up the next day and it gaps down 20%.
Sure.
Right. So then what we do is so then focusing on the swing part of the trade, swing part of the portfolio here, right? Let's say that. Right. So then what I do is I say, right, well, now given this, how would I scale in and scale out? So scale in and out. And again, the whole idea about me sharing this isn't for it to be exhaustive, but it's just to give some pointers and a guideline with which somebody might want to then start thinking about how to structure a plan, right? So there'll be certainly nuances and stuff, which I'm not going to go into today, but so scaling in and scaling out. Now, as far as SPY is concerned, I will never scale out. I will hold it. I won't sell out. And the reason why I'm going to do that is because there's just not enough volatility there. And so we start thinking about, well, why would I scale out in the first place? So let's answer that question. So why would you scale out in the first place? Well, for me, the reason why I would scale out in the first place is because there's sufficient volatility for me to profit from that move down. If there's not enough volatility to begin with, then I'm not even going to worry about it. I'm not even going to try. I'm just going to leave it there, right? And then as you go across the scale, then here I will scale in. And what I'll do here, let me, rather than putting in here, let me change this title here a little bit. Core position. Now, what I mean by core position here is how much of the position am I willing to hold at all times? In other words, if I don't scale out, I'm going to hold all of it at all times. So the core is 100%. I'm not trading around the core when it comes to SPY and QQQ. Right? So here, for example, let's say the position is well, no, 100%. That makes it easier, 100%. right? So I'm always going to hold 100%. When it comes to Apple, I might also hold 100%. But as I go further down, then the minimum I will hold of my swing position will vary as I go down here. So for example, in the case of Microsoft, because it's more volatile, I will only hold a core that might be 50%. In other words, I'm willing to scale out 50% of Microsoft along the way. When it hits resistances, when it hits weekly resistance or monthly resistance, I'll scale out up to a half, but I will never take it lower than 50% because we're in a bull market, because we're in bullish trends on the monthly chart. So I don't want to, so here the balance is, how can I take advantage of the volatility along the way without doing too much work while we're in a bull market? Right, so I'm trying to strike a balance here. But as we go across here, so here, for example, let's take a look at. I'm going to change Tesla to 3. I'm going to change this to 3 as well, just for the discussion, right? So here, when it comes to Tesla, my core position might go down to 30%, meaning I am willing to scale out 70% of that position because I know it's volatile as hell. So as we get to the weekly resistance, as we get to the monthly resistance, I will take profits on those positions, but I will never take my position down to below 30% of what I want to hold. And it's the same with NVIDIA, so 30%. So when NVIDIA gets to 448 or 440, I won't be holding more than 30% of that position there, unless, you know, we see a breakout and I'll start adding back along the way. But I will never take it lower than 30%. And so that gives me 70% to play with. Right, and basically it's the same as I go along here, and it's the same here. So 30%, let's say 30% on AMD, whatever the number might be, right? And for NG, I'm going to say, well, my core position is actually going to be 0, meaning I will trade all of it out if it gives me reason to do that. I'm not interested in holding a core swing position in NG because it's volatile as hell, and it's not my core, it's not my focus anyway, right? And it could be the same here for AI. So for AI, it might end up being my core might be 10% because I believe in it long term. So I want to hold a minimal position, even if prices go up or down. I'm going to hold a minimum thing. So you could, you know, one way to look at this core position here is how much do you believe in the long-term story of each of these things that you're holding? If you believe in the long-term story, but at the same time they're volatile, then you can decide how much you want to scale and scale out. And then you go down another level and say, right, okay, so how much of a position am I going to scale out each time? And then that's really just detailed. But what this framework sort of gives you is a very clear starting point to try and prepare yourselves mentally so that you don't end up over trading, because the risk is by not having a plan that you end up, just because NVIDIA pulls back 10%, whilst it's in an uptrend, you sell out. But you've already taken into account the fact that it's volatile, the fact that you're willing to hold a core position, so that you don't make these unforced errors along the way. And I think that's what really is the reason why so many people struggle to swing, because they make these unforced errors along the way because they don't have a plan with which to gauge sizing, position, and trading in and trading out. That's it. I don't know. I mean, it's a little bit more detailed than perhaps you were thinking, but I wanted to take you through the reasoning as to, you know, how I get from A to B. And once you set this up, which isn't complicated, I mean, just take you like half an hour once you've gone through the exercise, then you assign the numbers that you feel comfortable with. And I think like how big your core position is will depend on you as a person as well. So this is where we take into account your comfort levels when it comes to managing volatility in the trend. If you're like me, and I can get a little bit agitated when I see things moving, like for example, if NVIDIA moves 10, 15% in a week, then it doesn't annoy me that it does that. But because I'm trading full time and I'm active, like GP said, I want to take advantage of that. So rather than holding a large core position, you know, you could, you know, and it's the same with Tesla. So you could say, well, if Tesla is so wonderful, why don't you have this at 100%? Why isn't this at 100%? If Tesla and NVIDIA are so wonderful and they're going to do amazing things in the next 2 years. Well, the answer is, because I know they're volatile, I would rather take advantage of that volatility and keep it at 30% as a core and leverage that 70% that I'm able to free up every couple of weeks to be able to trade it more. But so it's going to come down to knowing what you want to hold, why you want to hold it, knowing who you are and how you're going to manage those positions based on your temperament and your behaviors to be able to then get through this. And I think, you know, so far it's been okay. I mean, I've come up with different versions of this to try and come up with how can we become more comfortable with swinging positions in a world where everybody is bombarded with news and noise. Price action is FUD as well. You see all those intraday algo movements and stuff. So how can we get from A to B in a safe, risk-managed way and not lose the opportunity along the way? And I think this is one way of doing it. And again,
I mean, this is just the spreadsheet of way of separating the signal from the noise, something that you and I have tweeted back and forth about, right? You've got it on paper that is like, all right, regardless of what happens, I'm going to hold 100% of these. I'm willing to swing in and out to some extent, but I'm never going to get out of my core position. Some of
correct. And then so these end up becoming your bread and butter. So what I mentioned earlier, if I believe in the AI story or technology and the QQQ as one of the instruments that's going to benefit, then whilst I'm having fun on the right hand side, I don't want to overtrade this. So whilst there's volatility along the way, so this is how I'm able to manage the dilemma in my brain is, even though prices are moving around, I can have my fun and take advantage of the volatility on this side of the chart whilst leaving these things untouched, right? So that's the basic idea. And then in addition to this, so this is the framework, then below this line are all the ways in which I'm going to trade in and trade out. So I'm going to use weekly and monthly time frame only for swings, right? So for swing trades, I'm only going to use weekly and monthly signals, whether they're moving averages or whether they're weekly and monthly pivots on the charts themselves. And what that also does then is it conditions me to trade less. I mean, we might be lucky and get volatility, quite a lot of volatility, and you end up hitting those pivots every day, but it's unlikely. So it makes you more patient as well. So you may end up trading Tesla maybe once or twice every couple of weeks in its current state, right? And it's the same with the others. So 371 is a partial exit for those who don't have, 100%, maybe other, if you've got 70% here, then if you're looking for an exit on 30%, then 371 was an exit on QQQ, for example, which was a weekly and a monthly pivot. So yeah, it's working. Yeah.
Randy in our chat asked, are the swing scalps based on dollar gain or percentage?
Well, it's size, it's dollar size of the
Dollar
portfolio.
size. Got it.
Yes, it's dollar size of the portfolio.
So you could do it by percentage of the portfolio, right?
You can do it.
If you have 10 positions open, like SPY might be 30, right? Or QQQ might be 30, and then AI might be 10, and then that's how you figure out your swing.
Right, and there's no rebalancing here. Right, so let me remind you. So if Google grows or Tesla grows, these aren't relative. This isn't relative to the others in the portfolio. This is just how much money do I want to invest in each of these positions to begin with. So it doesn't matter. So if Microsoft goes up 50%, it doesn't mean I'm going to reduce the size by whatever number it is to make it more, to balance the portfolio, let's say. So that would be one point I'd make. And the second point is, going back to GP's point, which I wholeheartedly agree with, is you don't need a bunch of stuff. If you can come up with a plan which is organized, then you probably only need, and I'll be honest, I've got, in addition to QQQ, SPY, Apple, Microsoft, Google, Tesla, NVIDIA, I've got some ARK, a couple of, it's probably 10, maybe 11, that's it. And if you're able to structure it well, it should work for you, because these things here on the left will account for all the names that you weren't able to pick. Because if the starting point is, well, if AI is so cool and wonderful, then all the market's going to be impacted by it, then you don't need to pick those biotech names. You don't need to pick those things that you think are going to make you a millionaire, but end up breaking your back because they're just so volatile. Well, if this is a 2-year story, which it could be to begin with, I mean, maybe we get blow off tops and corrections along the way and stuff. I think that if what we're thinking, and this is me stretching to all of you, if you're all thinking the same, that the market could go higher, if, like, at the end of the rate hike cycle, inflation is stubborn, but it's not growing, depending on which data you use. Corporate earnings are going up, not going down. Innovation is happening. So you've got lots of tailwinds. So if you believe in that, and the market's certainly supporting that, you're seeing uptrends everywhere. And those things which aren't necessarily strong uptrends are breaking year-long basis to the upside. Then there's certainly more arguments for the market going higher than going lower at this stage. Could things go wrong? Absolutely they could, and we'll reevaluate. But for now, and given how long we've been basing, then I'm reasonably confident that I think we could see decent gains in the next year or two. And I don't want to, so just as a final point, because I know I'm boring you to death, but I don't want to waste my time picking stocks if I can deliver at least 50 or 60% of my gains using these, and then just concentrating on the leaders. And that would be a core theme for me. I just want to concentrate on the leaders in each of the spaces. That's all I want to do.
It's excellent, Cookie. It's a great breakdown. One thing that I threw out to Randy in the chat is you can also use these swings as a way to build that core position higher, right? So as if you're not to the size in the SPY or the QQQ, you can use those swings to be able to add some and then take a little off, and then add some and take a little off until you're at that allocation that I would want to be at if I were the one doing this method.
Right. And I think, just to support that, many of the guys who have been trading with, they've been so scared to get on board because they think they've missed the boat. And they've been scared since March. So despite all the hard work, and it does, and this is why I keep going back to, it's a mental game. It's not just about prices and charts and numbers. It's really a mental game. So to try and get people more involved and to participate in what is a relatively easy market. I mean, we haven't had it this easy since August, and it's easier than it was in August. I mean, this market is easier than 2021 before the bear market. It's fucking insane. So given that, if people still aren't getting involved, then it's not because of the charts, it's because something inside their brain is holding them back. So one of the things I've been saying is just get in anywhere. Even if it's at resistance, I don't care. Just get in anywhere, but just don't buy huge.
The GIF I like to post, let me in, let me in.
Get in. Exactly. I mean, just hold a modest position, because the assumption is, which is erroneous, and it has been since March, is that each resistance is going to knock us back to 4,000 or 3,800 or 3,700 or something like that in the S&P, right? And every time that assumption has been wrong. So rather than making the assumption that every resistance is going to push us back, just buy any effing where, a modest position, understanding that we're stretched and we're far away from moving averages, and then pray for dip so that you can add. But do that as opposed to not being involved and feeling FOMO every day.
Yeah, it's like you're either, I guess, just based on kind of like what I've been seeing, and then like kind of talking to, the guys like last night, it's like either the people that are not involved are either the people that are afraid, thinking that they missed it, or two, think they know better than the market and there is like an epic collapse coming. So, I mean, either way, exactly to your point, it's like, how well do you know yourself and how stuck in your ego, like, really are you?
Yeah. And I understand
one more question from Randy. Are you first in, first out, or are you picking which lots to sell based on price, like highest price?
Or just based on highest price?
Yeah, that's me too. Yeah.
Yeah.
We got like 5, maybe 10 minutes if you're so kind, Cookie. I don't know if you have any charts that you want to share with us. You always give us a quick something on the charts that blows our mind, but I know you started your group back up, and I don't want to put you on the spot too much.
It's okay. Look, I can share a couple of stuff.
Your favorite two, whatever your favorite two that you want to look at are.
Well, I think the most useful two would be looking at the market. All right. So, I mean, we could look at NVDA and Tesla and all that stuff, but I want to just talk about the market, because I think if I'm able to help set the scene with regards to what the market's doing, then I think that might be more useful than looking at individual stocks, just in terms of usefulness to the guys who are listening, right? So this is my QQQ chart, which I've shared a bunch of times on Stock Twits as well. And so what I'm doing is I'm looking for places where the market could pull back and give us a rest, right? And one of the insights I could share is, typically what price does is when it meets at a similar trend line or boundary, it'll tend to do similar things to what it's done in the past, right? And let me explain what I mean by that. So here you see price. So this is QQQ on the monthly time frame, which is why it looks quite clean, right? It looks easy when you look at it like this. You can see how, so this is the month of June, which is pretty accurate. So I thought remember I posted this just after we went up from 347, and I said 347 could be the low of the month. Right now, So far it is. I mean, clearly it could die. The market could die in the next 10 days, but certainly for now, it's looking like that was a good call. So 347 is the low of the month, and we get to this trend line here, or the top of this green area, which is 371. So one of the things that I'll often do is I'll look across the chart at a similar area and see, well, how did not just that we might find resistance here, but the insight is price will often behave in a similar way. So it's not just pulling back, but how does it do that? And so when you look across the chart, and you'll see areas like this. So for me, this area here in the chart, which is back in 2020, after the COVID bottom, so we could start drawing parallels to how this market is moving now to how it moved post-COVID. So clearly there was a bunch of months here where the market went nowhere. But then once it got its shit together, it's actually moving not that different to how we moved following the COVID bottom. Now, the COVID bottom got to the same resistance back in 2020, back in September 2020. And then what that did was it set up a consolidation, which was pretty violent, that lasted 2 months. So this is from 300 down to 270. So that's 10%.
So in my fear right there on that candle.
Absolutely there is, right? And you can see how messed up these 2 months were. Look at that. And this is just an impressive shakeout. So to set the scene, you get a very strong move up from the COVID lows, which gets to this area of the chart. And then you see a 2-month shakeout, which doesn't break trend, right? And it's important that I said that it doesn't break trend. It doesn't even get to the 9 monthly moving average if you're using the 9MA on the monthly chart as a guide. But that happened. So it's certainly possible that it happens again. So going into the summer, my worst case scenario, which is still bullish, is we get down to 325 in the Qs. My worst case scenario, right? So what I'll end up doing is I'll come up with a bunch of different ideas to try and explain what might happen in the coming months. And then we'll work through those scenarios based on which supports are actually lost. Right now, clearly, in order to get to 325, or let's say it happens in a couple of months' time, which is 330, right over here. In order to go down to there, we need to lose the previous week's low. We need to lose 347. So you end up delimiting this space or demarking it, and you say, right, okay, so let's split what could be a potentially hairy consolidation in the Qs based on 347. So whilst we hold 347, the market is fine. Now, 347 from where we are, 367 to 347 is $20, right? So $20 from there is what? I don't know, my math isn't great. 6%, something like that, right? So I'm thinking 6% would be a pretty hairy pullback considering the strong uptrend, right? But I'd be okay with that, and I would welcome that. As long as we don't break monthly moving averages, I'm okay with even down to 330. So I want dips. I want pullbacks. I don't think we'll get that. But at least I'm mentally prepared for that. I don't want to be prepared for that in case we get it. I don't want to shy away from an opportunity if the market comes back down to 347 for whatever reason. Now we have stalled at 371. So whilst we're below 371, we're open to a consolidation between 347 and 371. If next week or this week we moon through 371, then we'll end up at 450 at the end of the year.
Okay,
right?
I don't think that, like what you just said, I do not think can be stated enough. If you're like to be in a state of mind where you're praying for dips, you're already in a place where, like, if the dip happens, you're like, this is a gift, this is a gift, this is a gift. Not in a state of mind where you're like, oh, this is rolling over, this is going to zero. Oh, this is like you're looking at you're looking at that pull-in as like a complete opportunity. Anyways, I didn't mean to
well,
interrupt.
no, we picked that same thing off with IWM a couple weeks ago, right, Nick? That's the same trade that we talked about. If it pulls into here, this is where you buy, and not be like, well, it's going to go lower.
Right. So anyways, yeah, I'm sorry. I didn't mean to interrupt. I just wanted to say
I'm glad you said that, because it reinforces the point that I mentioned earlier, which is we're just not, many of us just aren't mentally ready for what might happen. I mean, I think as far as the market breaking down is concerned, we've got tons of information and scare stories and nightmares that, you can fill, a swimming pool with it. But as far as bullish takes are concerned, few and far between. So I think it's nice to have certainly a balance, whichever way it breaks. Now, the next thing that I do is to then evaluate how likely is it that we get to 347. Right, so given that that's my lower bound, comfortable lower bound, even though I'm okay prepared to buy down to 330, how likely is a pullback down to 347? And then you look at, well, how did previous pullbacks look in the current uptrend? So then you start evaluating, well, what happened in February and March? So February and March was when we had the first of the banks going tits up, right? So Silicon Valley Bank went down the toilet in March. So you had this type of pullback in the Qs, and then in May so this is April, and it was in May that we had the second round of banks having, or was it in April? I can't remember the dates exactly, but it was somewhere around here. But the point I want to try and make is that even with this uptrend, with these dips along the way, we're still up here. So one of the things that I mentioned to the guys that I'm trading with is, even with these speed bumps, Qs is still at 370. Imagine if we didn't have these every other month. So my going in position for the month of June was, it would be nice if we had another shakeout like in this month, which was February, and then April, and then June, to allow the market to cool a little bit. So we're not getting it this month, but maybe we get it next month. And even if we did, the market is still going vertical, right? And so you draw a channel like this. So this is even with these candles in February and April, the market is still doing, hold on, let me get rid of that. That's not good. This way. Let me draw it better. The market is still doing this. That. Right. So even with, so hopefully you can see that, right? So even with these modest consolidations, which could last a month each time. So that was a whole month where the market just went sideways and up and down and all over the place. And even this month here is very modest range, right? So even if we had these months where the market pulls back down to 360 or 355, or 355 is the weekly low on the QQQ. So that is my next level support. So if we hold 355 on any pullback, then we're not even going to get to 347. Because typically in a bull market, you'll see candles holding the previous week's lows, right? It's a sign of a strong bullish trend. So we might not even go below 355. So now I've got down to 355 is my first level of buying the dip. Please, God, give us down to 355. If we get below that, then maybe we'll get 347, right? So we're gasping for dips, right? Everybody wants to load up. So even with these pullbacks, that's what you get. So going back to the question which I asked a couple of minutes ago is, how likely is it that we're going to get to 347? The answer is, well, it's not that likely, because even with huge catalysts in the market hardly pulled back. So even with Silicon Valley Bank and even with the other banks that went down earlier in the year, each of those catalysts had a smaller impact. So one of the things that we've been looking at since October, right? So since this October, November was, what impact are each of these catalysts having in the market? And what we noticed was, whether it was crypto, and I mentioned this, I think, on a call back in December with you, was we had 3A Capital, and then you had SBF. SBF had a smaller impact in the market, in crypto, than 3A Capital did. And if you look now at what's happening with Binance and Coinbase, the impact in Bitcoin pricing and Ethereum pricing is smaller than what happened with SBF. Despite what everybody thinks with regards to Binance, Binance is the biggest in the world, and Coinbase, oh my God, what's going to happen, right? So despite the massive FUD, the impact to Bitcoin and crypto, well, the altcoins got slaughtered because they're in the crossfire with regards to SEC, but certainly Bitcoin and Ethereum, the impact on those two has been modest, to say the least. Ethereum is still at 1,700. It's crazy, right? I mean, if there was any reason for it to die, it was going to happen now. So what that does is it tells you again that it's with each passing catalyst, we're seeing the subdued effects in price. So it's telling you that there's something more important out there. And one of the things I think I posted on StockTwitch just a couple of days ago is, how do you measure the relative importance of the catalysts in the world? And what you'll find, and it's just a question that, if anybody wants to think about, they could have done. But the reason I mention that is, with each of these different events taking place, we're seeing less of an impact in price. So what that tells you is that the catalyst that is driving price is far more significant and important than the ones which aren't, or the ones which are giving you those shallow pullbacks. So then we go back to the question, how likely is that we go to 347? The answer is, it's unlikely unless some really shit thing happens in the world. So even though the starting point was this could happen, then what I started doing is, well, how likely is it? How reasonable is it? How far down could we get? And then you start understanding how prices move to get here. And whilst it's possible, it's just not that likely. We're prepared for it and we would love it, but I'm not going to wait for a 10% dip to add to positions because it might never happen. Right? So the reason why I wanted to share that with you is because what it does is it helps us frame dips in the market, consolidations in the market, and how reasonable and likely things are to happen or not. Because the biggest mistake I think we make as humans and traders is misaligned expectations. And it's those misaligned expectations that lead to errors and trading errors and errors in general in everything, right? So if our expectations are logical and well-grounded to begin with, then we're more likely to react on whatever happens that comes our way. And if we've seen them in advance, then we're probably more likely to react as well.
Mind blown.
Yeah, Cookie. So I don't necessarily do this too much on the monthly, but I do it a lot on the daily and the weekly. Somewhere along the lines of my journey, I've kind of adopted this belief that a 50% correction is in almost any trend is healthy and normal. And so basically starting at almost any horizontal base that I can find, I will continually stretch fibs from that breakout to the high point. And it gives me a technical frame of reference as far as like where we're at. And so like if let's say we hold like the 0.23, the 0.38, I'm gonna associate that with strength. I'd start to get nervous if like the 0.5 or the 50% retracement gets taken out. So I think in terms of what you're saying, like I'm totally on, like it makes a whole lot of sense. And like in my mind asking myself, like how likely is this going to happen, right? Anyways, yeah, that's awesome. Thank you.
It's a good exercise, and I think not enough of us do it. How likely and reasonable are expectations? And I think once you start thinking in those terms, then I think you're more, not only are you more prepared, but I think you're less likely to miss opportunities, because most of the time we have bad expectations, right? And I think that's what the market has shown as many people, I think this year, is that a lot of the expectations that people had at the beginning of the year, they just never panned out. And because they still hold some of those expectations, they're just not mentally prepared to be able to take on, better than expected outcomes, which is what this is.
Totally.
The time goes by too fast each time we do these, Cookie. And I know it's early or late, whichever way you want to look at it, where you're at. But always 1,000 thanks. So much appreciation and love for you to come on and share your insights as you freely do. So can't thank you enough, my brother. I truly, truly, from the bottom of my heart, just thank you for all the wisdom that you impart every time you come on.
Hey, no, and I love it. And I love to be part of like the discussion with all of you as well. And I think it's great to bounce ideas off each other. And, I'm more than happy to do this every few months. So do invite me back. I'll come.
Of course, we'll invite you back. We're on a quarterly routine now. You're part of the show, so we'll definitely have you back. But I want to be respectful of your time. We've gone over a little bit, but thank you so much. Thanks to everybody who tuned in. Nick, thanks for joining GP. Shout out to you. You had to hop off early, but thanks for hopping on. We just want to remind everybody, mash that like and comment and subscribe on there. We love when you do that. It helps us get the podcast out there a little bit to more people. So appreciate that. Thanks for joining in midday today. And we will be back every Monday with our normal TA report. But for this special episode, our quarterly check-in,